So the next speaker now is Giuseppe Ambrosio. Giuseppe Ambrosio is a chartered accountant, partner of Deloitte, and he will introduce a subject that is apparently concerned with accounting, but has many important financial implications. Giuseppe.
So, ladies and gentlemen, good evening. Let me thank all the organizers, Mr. Lauro, and of course, Mr. Josh Giesing, that I can't see at the moment. I'm sure it's right there. Thank you very much for making this possible. Okay, I'm honored to be here. Thank you also to my partners and my fellow partner, Carlo Laganà, that is sitting there. He's going to be willing to take all your difficult questions that you might have at the end of the presentation. The easy ones are for me. So, given the time, I want to give you a kicker so you can wake up. So, by the end of this presentation, you'll find to be richer because you might find to have 2 ships instead of 1, and you might find yourself running a more profitable business. The secret is listen to the presentation. It's going to be fun. Okay. So I've just few housekeeping items. This presentation was a 2-hour presentation. I reduced to a 10-minute presentation. So if you want the full presentation, you know it's going to be sent to you. If you want us to reperform the full presentation, we are at your complete availability. And I'm here you know, the evening and tomorrow with Carlo to answer all your questions. So let's go to the contents, the agenda. So we're gonna cover the IFRS 16 overview, the overview of lessee accounting, transition, and then industry consideration. Let's go straight to the. Okay, so just a very quick overview of where we are. We have a new standard, a brand new standard on lease that is going to be implemented on 1st of January 2019. This standard comes and replaces another standard, is IAS 17, that you might have heard of, which has been out there for almost 28 years. Now, these are the key changes we're going to have to deal with. And I've highlighted 3 areas. One area is the definition, which comes with a brand new guidance and a new concept of control. So we're going to have a brand new concept of control that is going to complicate our life all along the application of the standard. Then we have judgment. You know, with this new standard, we're going to have to basically express and materialize judgment. In the phase we have to identify the lease. In the phase we have to establish what's the lease term. And also when we want to have to define and find the incremental borrowing rate. Judgment comes with a deal of complication because judgment has to be then defined, documented, and the rationale behind the judgment is going to be part of the documentation you have to prepare and you're going to hand over to your auditors. And as you know, judgment means more work, basically. So the third big change is that the previous standard had just as 2 model to account for leases. Now we have a single model. Let's see why they've decided to do so. The reason behind change can be just simplified in these 3 points. First of all, the former standard has been criticized because it was claimed to be not transparent. The reason why is because basically the assets were basically hidden off balance sheet. There were no assets on your books while you were basically accounting for a lease. This is going to change, and also this improves transparency because you're going to assess clearly what's the leverage of a company. And another reason was comparability. The reason why this was a problem is because similar transactions having 2 different models sometimes ended up being accounted differently. So this was a big problem for analysts because they did not understand why. And this is a reason why they have chosen to just go for one single model of accounting, because this should improve comparability. Another reason was there was not enough required disclosure for credit risk. And now with this standard, we see that there's a much more additional disclosure required to clarify what is the risk on residual value guarantee, what is the risk for the lessor for the lease payments to be received. Now, you won't be an expert at the end of the presentation, but I'm sure that if you follow me through these next 2 slides, you know how to deal with this. So the first starting point is the definition. This is the new definition. So a lease is a contract or a part of a contract that conveys the right to use an asset for a period of time in exchange for consideration. What's behind this definition is very simple. Every time you sign a contract at inception dates for the standard is the earlier between the commencement term of the lease or the day you commit to the lease. So at inception date, you have to establish whether the contract you have signed, it's a lease or contains a lease. So what you do is you look for an asset. If in the contract there is an asset, and you can identify an asset, that's the first starting point. The other point is control. So you have to basically look for the right to control the asset. And basically, you have the right to control the asset when you can benefit, and you can benefit from all the economic use of the asset. So basically, you control the cash flow, and you can make it turn into profit for your company. The other point is right to direct use, which is basically you decide as you like when to use it, when to turn it on, when to and how to use the asset. I have prepared a very simple example that I think is very relevant for this audience. And I'll make also a further consideration about the fact that you might have 2 assets at the end. We have a very easy example here. There is a customer that enters into a contract with a supplier for the use of specified ship for a 5-year period. The ship is explicitly specified in the contract, and the supplier does not have substitution rights. The customer decides what cargo will be transported and whether, when, and to which ports the ship will sail. The 5-year period of use subject to restrictions specified in the contract. Then the supplier operates and maintains the ship and is responsible for the safe passage of the cargo on board of the ship. Customer is prohibited from hiring another operator for the ship of the contract or operating the ship itself during the term of the contract. So basically, by looking at these conditions, we have the use of going back to the definition, we have the use of an identified asset. The ship is explicitly identified in the contract, so we tick the first box. Then, no right to substitute. It's very important that there is no right to substitute the ship, because basically, if there were the substitution right, there's an argument that there is no identified asset. So in this case, we tick the first box. Then right to obtain economic benefits from the use of the identified assets. Of course, we have exclusive use of the ship. Then right to direct use of the identified asset, which is in the definition of control. So we have basically, we decide whether, when to operate the ship. Now, what's the consequence of this? That we have a lease. So we have identified the lease. Now, what happens is that we have to recognize a lease into your books, into the books of the company. And we have basically, on the liability side, we have all the liabilities that are basically made of the fixed payments contained in the lease, but at their present value. Plus, there are the variable lease payments based on index that we have to add. Then we have other minor, if you like, components. What's important is that once you identify a lease, the first step is to quantify the liabilities. So the first entry you will have on the books, you will have right to use the asset, and then you'll have liabilities. Then debit assets, credit liabilities. So basically, if you entered a lease and you're a customer, you will have in your books a ship, and you'll classify this ship, which is basically very close to a ship, but it's basically the right to use the ship, indeed. But what's going to happen on the other side, on the supplier side, given that the IFRS 16 leaves the lessor accounting basically unchanged, the lessor, if he classifies that lease as an operating lease, will keep on showing on his balance sheet the ship, because he owns the ship. So basically you will have at the same time a supplier, or you and the ship owner, that will show the same ship on their balance sheet. So you duplicate the asset. So that's something you want to...
Giuseppe,
see, quicker.
Almost done.
See, quicker. So there are some recognition exemptions. You don't need to recognize the short-term lease and the low-value leases. Then this is a very visual, this is something that you want to concentrate on, because basically IAS 17 is the previous accounting. And under the previous accounting, the operating leases showing in red the boats and the buildings, and were off balance sheet. Now, IFRS 16 brings them up. And on the right side, what's really interesting is also that you're going to have a more profitable business. Why? Because the operating leases were shown as a single expense within operating. Now, you're going to have depreciation and interest. What's the consequence of this? You're going to have a higher EBITDA. So if somebody wants to buy your business, it might be worth a bit more if they do not understand clearly what's happening here. Now, these are the consequences you have explained. Transitions, there are two possibilities. Either you do a full calculation retrospectively, so you're going to have the two comparatives that basically re-perform all the calculations according to the new standard. Or there is a very simple approach. It's called the modified retrospective approach, where basically you show all the accumulated difference within the opening balance of retained earnings. This is the easiest option. You lose on comparability, but basically it's more cost effective. Okay, so it's up to you to decide. I'm going very, very quick. So this is the conclusion. I'm done. Now these are things. This is food for thoughts. This is food for you. It's things you want to think about. Impact on financial ratios. EBITDA is going to change. Earnings per share is going to change. So you might want to think of what happens to your key performance ratios. Then covenants, you might want to have a check of what's going to happen to your covenants. So you don't want to be sorry with this. Then there is an argument that cost of borrowing following this standard might be reduced. The reason why, because you're going to be more transparent to the banks, and they might be more willing to lend you money. One thing you want to think of is compensation. If you have a bonus for your employees that is based on EBITDA, for example, the day you implement IFRS 16, EBITDA is going to be higher, so this might going to kick some bonus in. So have a think about this as well. On the right side, more on the operational things you want to think about. You need a plan. For IFRS 16, you do need a plan. A plan needs to involve IT, legal service, and people. You want to train your people, and you want them to be involved with this new standard. And of course, you want to have a thought also about tax and regulatory consequences. That's all, folks. Thank you very much.